5% of your net worth should be in physical gold. I never change that mantra. And then I toggle the difference between 0 and 20% in what I call liquid paper gold. And that is not, you don't really own gold unless it's in your physical possession. But if you're going to rely on a third party, then it becomes an investment. So it's liquid because it's in ETFs and in stocks. And it's paper because it's not really gold in your possession. Between 0 and 20, and we're close to 10% right now. And why? Why is that? Because nominal rates are now falling and real interest rates are falling. And that is the perfect time to own gold.
MichaelPento is a seasoned financial analyst, investment manager, and founder of Pento Portfolio Strategies. In this video, Pento advises allocating at least 5% of net worth to physical gold as protection against currency devaluation. A key attraction to gold is that its correlation to equities has been close to zero over long horizons and largely invariant to the inflation level. And over the last 170 years, gold has successfully delivered a positive, although not very high, real positive return. Gold allocation is viewed primarily as a diversifying asset, a hedge against geopolitical risks, and the possibility of an inflation overshoot. In his assessment, Pento criticizes the selective exclusion of factors in GDP calculations, noting that growth projections have plunged from 4% to 0.4% even without gold exports. He warns this sharp decline signals an economy on the brink of recession. President Trump sparked concerns this week when he declined to rule out the possibility of a U.S. recession this year. Asked on Fox News if he expected such a slump, Mr. Trump said, "I hate to predict things like that. There is a transition period because what we're doing is very big." Based on various factors, Pento distinguishes the dollar's value against fiat currencies and hard assets like gold. He notes slowing U.S. growth and falling interest rates make the dollar less appealing globally. Meanwhile, he mentions this as a bullish signal for gold. In times of global financial crisis like the 2008 recession, gold prices surged as investors flocked to the safety of tangible assets. In this case, the U.S. dollar also gained strength, reflecting its role as the world's reserve currency. The dollar might weaken while gold prices increase. Now we present the clips of MichaelPento's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, first of all, I hate when people say, if you take out this or take out that, not that you said it, but that's what listen, the point is,
what the Fed did. The Atlanta Fed did. Right?
The Atlanta, when was the last time, did they ever take out for gold exports? Have you ever heard that? GDP would have been a lot worse if we didn't, So, it's C plus G plus I plus or minus net exports. So even if you were to take out gold from the calculation, I think it fell from 4% growth predicted in February to 0.4%. Okay. So that's still very much close to a recession and stall speed for the economy. So I increased my gold position. I've had it. First of all, let's just talk about gold. 5% of your net worth should be in physical gold. I never change that mantra from me. That is my recommendation. You always have a placeholder of your wealth that cannot go down. Your purchasing power cannot be ruined by a fiat currency if you have 5% of your assets in gold. So it's liquid because it's in ETFs and in stocks. And it's paper because it's not really gold in your possession. And why? Why is that? Because nominal rates are now falling and real interest rates are falling. And that is the perfect time to own gold. When you look at the second derivative of inflation in the context of growth, it's another expression of what you think the dollar is doing. And when I talk about the dollar, there's two ways I say to myself, what is this person asking me? Are you asking me, what is the dollar doing against the yen or against the renminbi or against another fiat currency, against the euro? Or what is the dollar doing against gold, against hard assets? Gold is another form of money. So the dollar is a form of money and the gold is the better form of money or the real money. So against real money, gold, it's depreciating in value. The dollar is depreciating in value, so the price of gold is going higher. That is absolutely clear to me. It's been that case since really on and off, but mostly on since 2000, Kai. All right. Now, when you talk about against the flawed fiat currencies it's measured against, you have to go on a country by country basis. Right now, it looks like the dollar could be even losing ground against other currencies for the time being because of our slower growth rate. So if our interest rates are coming down and the growth rate is slowing, that makes holding dollars less appealing. The fact that our government is prone to sanctions and confiscation of other countries' wealth, freezing their assets. So foreign countries are eschewing our dollar with their trade surplus. So they no longer want to buy, to recycle their trade surplus into our bonds and in our dollar. So that's also part of the bullish gold story and the weakening of our currency.
While discussing the fundamentals, MichaelPento warns that rising wage demands hurt small businesses and fuel inflation. He views inflation as a loss of faith in fiat currency due to debt monetization, noting that tariffs cause temporary price shocks, not ongoing inflation. Inflation in February rose 2.8% annually, slightly lower than economists had forecast, but continuing to signal that price hikes remain elevated despite the Federal Reserve's efforts to tame inflation to a 2% annual rate. The global financial system faces a structural shift as fiat currency regimes struggle with inflation. The decline of US dollar dominance, the rise of algorithmic trading distortions, and increasing financial surveillance risks necessitate a more resilient monetary framework. Regarding passive investment strategies, Pento argues that today's market requires active management. He highlights how Fed policies, zero interest rates, QE, and trillions in money printing have fueled gold's strength. Let's get back to the interview.
Well, reading the NFIB, National Federation of Independent Business survey that came out this morning, the number one complaint that small businesses have is that they can't hire the right people, and the people that want to be employed by them are asking just astronomical salaries. Compensation is through the roof. So that's a big problem. So inflation is a huge problem. I mentioned earlier that 4 years now it's been above 2%. And tariffs are a one-time tax, a one-time increase in the level of prices. So it is not by definition inflation. You know what? If you listen to the Federal Reserve, inflation comes from too many people being employed and too many people being productive. That's their definition of inflation. It's actually, the most incorrect of all of their models and philosophies that they hold on to. Inflation is when the market loses faith in a fiat currency's purchasing power because it's been destroyed by monetizing government debt. That's how inflation arises. So it's an inexorable, it's a protracted increase in the level of prices, continuous and protracted, because the market has lost faith in the purchasing power of a fiat currency. We don't have that yet. We're headed down that road, and tariffs are not part of that calculation. Will they increase prices? Yes, they absolutely could. Now, there's other ways. Let's just, you mentioned tariffs. Let's just talk about it for a second. The exporting country that the tariff is, the duties imposed on, could eat in their margins and cut their prices. The exporting country could also wreck the value of their currency, so there would be no change. You could source products. The importing country can source their products from other nations. The importing nation, the United States in this point, can also take or eat some of those tariffs and decrease their margins. So it's not an like 25% tariffs on X, Y, or Z product is not a 25% increase in prices automatically. When you have a problem with inflation, the worst thing that you could do then at that moment for as far as inflation is concerned is to have that one-time increase, but it's not going to be something that's continuous. What I do is differently. I actually sit there and say, I'm not going to set it and forget it. This is not a set it and forget it time to manage money. Maybe it was in the 50s and 60s, but not now, especially not, since 2000 and really since this new era of interest rate repression, where you saw real interest rates at minus 8% on the Fed. The real Fed funds rate was minus 8%. That is never before even close to being thought of happening. So you have this is the regime of helicopter money, of ZERP and QE. It's worth mentioning that the Fed's balance sheet was $800 billion prior to December of 2007, when the start of the Great Recession, and it went up to $9 trillion. So that's $9 trillion from $700 billion. Okay, when I went to school, that's $8.3 trillion of the Fed printing credit. That's Fed credit, Fed reserves printed willy-nilly by fiat to battle a housing bust, the banking crisis, and then COVID. That tells you something about why gold has been doing so well lately. Try increasing the money supply, the gold mine supply by 20% per annum year after year. It just can't happen. It's physically impossible. That's what makes gold so special and so beautiful.
Recent years have brought dramatic swings in gold prices and the US dollar, driven by global events, central bank policies, and shifting investor sentiment. Regarding the maximum potential of the gold price in 2025, more than 75% of experts considered a maximum price of $3,000 or more possible. However, none of the analysts surveyed expected an average price at this level. Do you believe gold will continue to outperform in the current economic climate? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.